Hey everybody, welcome to episode 3 of the SaaS Report. I'm Matt Ed, your host and CEO of Sales Science. Today we're going to be looking at a new SaaS metric that I learned about this week called the Rule of X. It's invented by Bessemer Venture Partners, so I'll break down what that is and why it matters. We'll also take a closer look at the project and workflow management space. So diving into the metrics behind Smartsheet, Asana, and Monday.com, how those compare, what their trajectories look like, and how they've progressed over time. And then finally, we'll wrap up with a bit of a preview on a new company that's launched in the go-to-market space called Operator. Interesting background here. I'll bring you the news on that, and we'll take a look at the implications potentially for that product in the go-to-market landscape. First of all, let's get started with a breakdown on some Q2 reports from companies that have reported over the last couple of weeks. First up, let's take a look at Zoom. So everyone knows Zoom. Zoom has become a verb now almost, and they've transitioned from an extremely high growth company to a company now that is just a cash flow machine, but is struggling to kind of grow the ARR base. So in Q2, Zoom generated $2.43 million in after-tax profit every single day of Q2. They had $365 million in cash flow, up 26% year over year, $219 million in net income, up 20% year over year, ARR growth of only 2%, right? So here's the rub. They've created this business which is extremely efficient at generating cash flow, operating income, and net income, but they're really struggling to grow top-line revenue. And the reason for that is that these solutions are now saturated within the market, right? It feels like everyone has a video conferencing tool. The free or cheap solutions are just as good for most people as the premium offerings. And that's making it hard for ZoomInfo to go out and find new customers and get them to sign up to subscription. So they really need to find the next growth driver. They're working on, I believe, a contact center strategy. So how voice phone can help organizations with really large contact centers to improve efficiency, but without a clear strategy on how to drive top-line growth, the share price is just going to continue to trade sideways. Share price is basically unchanged year over year, and they're trading at about 4.5 times ARR at the moment. Snowflake also reported Q2 numbers recently. Snowflake had the largest software IPO ever, coming out at a valuation of $33 billion. But the story hasn't been that good for them since going public. In Q2 of this year, they spent almost $1 million per net new customer that they acquired, right? So $938,693 to be exact, right? Spent per customer, they added 427 net new customers in the quarter. So spent $400 million on sales and marketing to add about $160 million in net new ARR in the quarter. That gives them a magic number of 0.4, down from 0.6 in Q2 of last year. CAC payback was up also a lot, so that's at 45 months now, up from 29 months a year ago. So they're spending a lot of money to try to generate net new ARR to bring new customers on board. Now this can be justified somewhat, right? If you're spending, almost $1 million to get a customer, you want those customers to be paying you a lot, and Snowflake is in that position. So an average customer pays them about $340,000 per year, but they're not achieving this growth in a fiscally responsible way, right? We've talked a lot in the first couple of episodes around the transition that public SaaS companies are making from this kind of like growth at all cost mindset to this growth at a reasonable cost mindset. Snowflake, it doesn't look like has received that memo, right? So they've got a negative 41% operating margin for Q2 and a net loss of $317 million for the quarter, right? To add to this, they're just not growing at the same rate that they were, right? So they're burning a ton of money and growth has gone down substantially. So 8 quarters ago, they were growing at about 83%. That's down to just 29% in Q2 of this year. So not a great picture for Snowflake, right? Decreasing sales efficiency, increasing losses, slower top-line ARR growth, and that's really reflected in the share price. So share price is down about 41% year to date. They're trading at just over 10 times ARR right now. Next up, we've got Confluent. So Confluent is a company that helps their customers get access to real-time data, right? So they're a company that basically creates the pipes and the infrastructure for their customers to be able to move data around into the applications and the databases that they need it in. So a really big use case for them, obviously, is empowering organizations to deploy AI, right? Confluent's really important in that infrastructure to make sure that the models and the applications that these organizations are running have access to the data that they need in order to generate, the outputs. So Confluent spent $410,000 on average to acquire each new customer in Q2. So they added 320 customers in Q2, spending about $130 million on sales and marketing to do it. Whilst that sounds outrageous, it's actually a big improvement on Q2 of last year. So 12 months ago, they spent $920,000 per net new customer in Q2. So CAC payback for them is down from 37 months to 30 months. They've got a magic number of 0.54, and they've made some effort to really cut back on OpEx. Again, this is a story of, right, let's get the business into a position that is more fiscally responsible. So Confluent's making steps to that. So they've improved operating margin from negative 63% to negative 46% in Q2 of this year. And they had their second ever quarter of positive free cash flow margins. So interestingly, they've got a fairly large negative operating margin, so 46%. But they've also got a ridiculously high ARR per employee number, right? Which means that if you think ARR per employee is basically how much ARR do we generate, divide that by the employee headcount in the company. That comes out at $609,000 per employee. Right? The gold standard for this metric across a lot of the companies that we track is around 400 grand. So what that tells us is that Confluent isn't overstaffed by any means, but they may be paying these people a lot, or they've got a lot of costs that aren't reflected in headcount, right? Whether that's, advertising, whether that's payments to third parties, whatever it might be. So still a lot there that they need to do in order to improve OpEx, but it doesn't look like, being overstaffed is the issue for them. So pull all of this together, and Confluent's trading at about 7.1 times ARR right now. Final company we're going to look at today on Q2 results is SentinelOne. So SentinelOne is interesting, right? They're a direct competitor of CrowdStrike. So we looked at CrowdStrike last week. We know that CrowdStrike had the issue with the global IT outage caused by a release that they did in Q2. And what we saw from the CrowdStrike announcement was that they saw some revenue impact as a related of that outage, right? And so naturally what that should mean is that CrowdStrike's competitors are the ones that are going to benefit. Now, SentinelOne is a direct competitor of CrowdStrike. They basically offer the same thing to the same customer sets. Now, we can't see in the numbers yet any direct impact from this, but on the Q2 earnings call, the CEO was very bullish about the fact that they've had a lot of customer inquiry from existing CrowdStrike customers and have even closed some deals with existing customers. We should see more come over the next couple of quarters, right? So nothing materially in the numbers as we're about to see, but potentially some tailwinds for them off the back of CrowdStrike's issues in Q2. So SentinelOne spent about $120 million in sales and marketing in Q2. And generated $44 million in net new ARR quarter over quarter. That gives them a magic number of 0.43 and a CAC payback of 37 months. That's down from a magic number of 0.65 and a CAC payback of 26 months from the same time last year. On top of that, they're still burning cash, right? So sales efficiency is decreasing. They're still not cash flow positive, so they had about negative 3% free cash flow margins for the quarter, and a net loss of $70 million. Operating loss did reduce by 20%. So again, they're taking steps in the right direction, but the market isn't satisfied that they're doing this fast enough. The share price is down about 16% year to date, and they're valued at 8.7 times ARR right now. That's it for Q2 numbers this week. We'll have more to come next week. Now let's jump into the first main topic of today. We're going to be looking at a new metric that I uncovered this week called the rule of X. So I can't actually remember where I first saw this. It was somewhere on LinkedIn. And there was a post about the rule of 40 and growth rates. And someone in the comments had mentioned, and I should try to find who this is so I can give them credit, but they mentioned the rule of X. Now I'd never heard of the rule of X before, and so I looked it up, and it turns out it's a metric developed by Bessemer Venture Partners. Now, the idea behind this is very similar to the rule of 40, right? The rule of X takes into account a company's growth rate and a company's free cash flow margin in order to understand kind of the combination of those two metrics to get a better understanding of how this company stacks up versus another, right? And the trade-off that they're making between growth and generating free cash flow. Now, to find the rule of X, we do the same thing, right? So we get growth rate, ARR growth rate, and we get free cash flow margin. But instead of just summing them together, what we do is we place a multiplier on the growth rate number. And the idea here by Bessemer Venture Partners is that growth for SaaS companies is more important than free cash flow. So we want to reward companies that are growing at a faster rate than their peers, kind of not irrespective of free cash flow margin, but we want to put more emphasis on the growth rate as opposed to the free cash flow that's being generated. Now, the way that they came up with this is that they analyzed the valuation of public SaaS companies, and what they did is they looked at what's called the R squared of the rule of X. Now, I had no idea what R squared was, so I asked Perplexity to explain it to me, and here's what Perplexity says. R squared is a statistical measure that tells us how well one thing explains or predicts another thing. It's like a scorecard for how good our guess is about something based on other information that we have. So here's a simple way to think about it. Imagine you're trying to guess how many ice cream cones a shop will sell on a given day. You decide to use the temperature outside to make your guess. R squared would tell you how good temperature is at predicting ice cream sales. With R squared, you get a number between 0 and 100%. If R squared is 100%, that means that temperature is a perfect predictor of how many ice creams you're going to sell. So every time it gets hotter, ice cream sales go up by exactly the right amount. Okay, so that would give us an R squared in that situation of 100%. If there was no connection at all, then what we would see is that temperature increasing would have no direct impact on the number of ice creams sold. And in that situation, the R squared would be 0. So typically what you find is that the R squared is somewhere between 0 and 100, right? The higher the number, the better the predictor. Why do we need to know that? Basically what they were trying to find is the rule of X a better predictor of the valuation of a company than the rule of 40? Okay, so if the rule of X generates a higher R squared value, then it's likely a better predictor of a company's valuation than their rule of 40 score. And so when they did this analysis, they found that R squared for rule of X was 62%, and for the rule of 40, it was 50%. So it turns out that this rule of X is a better predictor for how valuable a software company is, right? So that's just a long way of saying that the idea behind growth being more important than free cash flow for software companies holds true, right? At least in the way that they've done the analysis. Now, the way that we calculate this rule of X is so we take growth rate, we take free cash flow margin, and then we put a multiplier on the growth rate. So typically what they recommend for public SaaS companies is that multiplier is a 2x. So you basically take the growth rate, if it's 15%, you times that by 2, which would give us 30, and then you add the free cash flow margin. Now, Bessemer has been kind enough to give us a good, better, best framework, which we can see here. They're saying good is somewhere north of 40%, better is somewhere north of 50%, and best is, if you have a rule of X, north of 70%. Okay, so that's a new metric that we've identified. I'll be adding that into our Q2 SaaS metrics report, so we'll be able to analyze how the companies that we track stack up on that metric, and we'll be able to see if there are any interesting kind of differences between how a company stacks up in rule of 40 versus how they stack up in rule of X and the ultimate kind of like ARR multiple that they get. So I'll do some of that analysis in the Q2 SaaS metrics report for you. Now, the reason that I wanted to give you that metric breakdown first today was that the main topic of conversation for today is this analysis of the project and workflow management software space. So project and workflow management is a really crowded market, right? We've got public companies like Monday, Asana, and Smartsheet that we'll be taking a close look at today. We've also got Atlassian, who plays in the space a little bit as well, with the likes of like Trello and Jira. And then we've got a bunch of private companies that also are in this space, right? Think ClickUp, Notion, Basecamp. And so you've got a really crowded market all going after the same spend from customers. So because we've got three public companies that all kind of compete in the same way, I wanted to do a bit of a breakdown on the three companies and how they stacked up across some of the core SaaS metrics. So the first thing that we're going to look at are the ARR run rates for Asana, Monday, and Smartsheet. So as at Q2 of this year, this information is a little bit outdated. Monday released an update a couple of weeks ago now, pointing out that they had crossed $1 billion in ARR, but at the time of Q2 reporting, they hadn't yet. But as you can see, at the date of Q2 reporting, Smartsheet leads the pack here in terms of ARR run rate. So Smartsheet's at over $1 billion, so 1.054. Monday's at 944 million, and Asana is at 717 million in ARR. All right, so this kind of tracks with the age of the company. So Smartsheet's the oldest. Monday and Asana were founded around about the same time, but Smartsheet does have a lead on these guys in terms of being founded, I think, 5 or 6 years prior. All right, next we look at ARR growth rates. So all three companies have had decelerating growth rates over the past 4 years, and that kind of makes sense, right? As a SaaS company scales, it gets harder to generate the same growth rates. But what we can see is that throughout that time, Monday has been growing at the faster rate. So in Q2 of 2020, Monday was growing at 113% versus 58% for Asana and 43% for Smartsheet. At Q2 in 2024, there's been a slight flip, so Monday's still growing the fastest, but Smartsheet is now outgrowing Asana, which isn't great news because Smartsheet is at $1 billion in ARR, Asana's only at 700 million. So Smartsheet's finding a way to grow faster than Asana, despite the fact that they've got more than $350 million ARR lead on them. So Monday growing at 34, Smartsheet growing at 19, Asana is growing at 10% right now. All right, so ARR growth rate is one thing, but how do these companies stack up from a go-to-market efficiency standpoint? So the way that we'll look at that is to analyze last 12-month CAC payback rates and last 12-month magic number rates for the three companies. Now, the difference here between kind of last 12-month or current is that it just gives us a broader viewpoint, right? Rather than taking a snapshot in time, which is 90 days, we're able to look at the CAC payback and magic number performance over 12 months, which gives us a more balanced view of how a company's performing. Because it can be that a company can have an outlier one quarter to the next where deals push or marketing spend increases due to conferences or events or whatever it is, right? So if we take a longer term view, these numbers kind of normalize out. We get a clearer picture of how a company's performing. So from a magic number standpoint, Monday again leads the pack. So they've got a magic number of 0.52 versus 0.46 for Smartsheet and 0.27 for Asana. As to be expected, right, we saw a peak in these numbers for these three companies around the COVID pandemic time. So we saw this, improvement in sales efficiency for basically every SaaS company during that period as, spend on technology and SaaS increased significantly. That has tailed off over the last couple of quarters, but Monday's been able to maintain the lead there with Smartsheet coming in second. Next, let's look at CAC payback. So what we can see here is CAC payback for Asana has exploded. That's at about 80 months now for them. Smartsheet sitting at 47 months and Monday sitting just over 25 months. Right, the interesting thing here is that there has been this really big divergence, right? If we look at Q2 of 2020 through to Q2 of 2022, all three companies were operating at a fairly similar rate. And then we had this big divergence in Q2 of 23 and 24 where Asana's sales efficiency fell off a cliff. Smartsheet's got a little bit worse, and Monday's kind of held the course, right? They were at 25 months this quarter, and at 20 months at their peak in Q2 of 22. So they've done a really good job there of holding on to sales efficiency, even as the company scales. The other two, right, not so much in this situation. Now, looking at the transcripts on the earnings calls and looking at the quarterly reports for these companies, what we can really see is that there is an increased focus on wanting to move up market. Right? All of these guys want to get out of kind of the transactional business being the core foundation of their customer base, and they're trying to get into the mid-market and the enterprise. They want larger deal sizes. And the reason for that is that all three of them report much higher net revenue retention rates on larger contract sizes, right? So on the 50K, 100K plus per year, net revenue retention rates for these guys is much better. So if we can win that business, it becomes much stickier, it expands, and we're able to grow revenue much more efficiently in the future. So let's have a look at how these companies stack up from the viewpoint of how well they're going at penetrating these larger customer bases. So we can see that Smartsheet has a big lead here, right? Smartsheet has been a solution developed for the enterprise for a long time now. I think they boast about 80% of the Fortune 100 as Smartsheet customers, and they've been playing in this space for a long time, right? Because of the fact that they're older, they were founded in I think 2005, 2006, they've had a lot more time in the market to be able to build relationships and develop a product that's built for the enterprise, right? Often what we'll see is that these workflow and project management solutions start off as SMB focused, and then they gradually make changes and development to get it enterprise ready. Smartsheet's just been in the game a lot longer, so they've been able to make that transition in a way that's allowed them to capture a lot of this market. So Smartsheet has over 4,000 customers at the moment, paying them more than $50,000 a year, compared to 2,700 for Monday and 1,100 for Asana. Right, so a really big lead for Smartsheet there, even compared to Monday. Now, another way to analyze this 50K plus customer cohort is to look at the rate of growth within that customer base, right? So it's okay to look at, how many total customers do we have, but the other way to look at it is how fast is that customer base expanding. So when we look at that, we can see that Monday did a really good job of growing this customer segment in Q2 of 23. So they had 300% growth in this customer cohort, going from 470 to almost 1,900 customers during that time. That growth has tailed off, so it only grew 43% year over year. Asana is growing this customer segment at 90%, but again, you'd expect them to be able to grow this quicker because it's coming off a low base. And then Smartsheet, this has been trending kind of, down and to the right, not as aggressively as what we saw for Monday. And so this, I think, is going to be the two charts to watch over the next couple of years, right? As these companies try to battle for the kind of larger mid-market and enterprise, these will be the two charts to track to see how they're making progress there. This is an extremely important segment for Asana because they actually have negative net revenue retention across the business as a whole, but have 105% net revenue retention with this customer segment, right, with the 50K plus. And so the survival of their business basically is going to come down to the fact of can they make the jump and continue to grow this customer segment, right, whilst Smartsheet and Monday are also trying to do the same thing. From a rule of X standpoint, again, we see that Monday leads the pack here. Their high ARR growth rate means that they're able to generate a higher rule of X. Asana started off strong, 3 or 4 years ago, but that has since tailed off due to the fact that their ARR growth rate has declined. And Smartsheet has been fairly consistent on this metric since 2020. Now, how does all of that roll up into valuation? Well, what we can see, and I think based on the numbers, right, this is justified. Monday has the highest market cap to ARR multiple, sitting at just under 14 times ARR right now. Smartsheet comes in at 6.9 times, and Asana is sitting at 3.6. Now, I think the reasons for this is fairly clear, right? Monday is growing at a faster rate. Their sales efficiency is better. Smartsheet's at somewhere in the middle there, and then Asana is the laggard on both of those two metrics. Right? The other interesting thing to look at here is this quarters taken to get to different ARR milestones, right? Because one of the difficulties we have in comparing these two companies is that Smartsheet is significantly older than both Monday and Asana. So Monday and Asana were founded in about the same year. Smartsheet was founded about 6 or 7 years earlier. So they've got a bit of a head start. But what we can do is go back and look at how long did it take these companies to get to different ARR run rate milestones. And when we look at that, we can see that Monday is growing faster than the other two, right? So Asana actually got to $100 million in ARR the fastest, right? So it took them about 27 quarters to go from 0 to 100 million. It took Monday 31 and it took Smartsheet 46. But then Monday took over, right? So it only took Monday 10 quarters to get from 100 million to 500 million, and then only 9 quarters to get to 500 million to $1 billion. Asana still isn't at $1 billion. They've been working on that 500 million to $1 billion jump for 9 quarters now, right? And they're still only at 716 million in ARR. And so when you look back retrospectively, yes, you could make the argument that, hey, look, Smartsheet's more established. They're at a higher run rate. They have more penetration into the enterprise. The growth rate isn't that much slower. The sales efficiency isn't that much slower. But if you look at the time that it's taken Monday to get to these results, you can see that the momentum is on their side, right? So I think justifiably, Monday gets the highest valuation, Smartsheet comes in below them, and then Asana is the laggard. They've really got a lot of work here to do, right? They've got bad sales efficiency, they've got slow ARR growth. Asana really needs to find something to turn the ship around here if they're going to be able to compete with these other two and the handful of private companies moving forward. All right, final thing to cover today is the launch of a new go-to-market SaaS product called Operator. So Operator is a company that's been incubated inside of the GTM fund. So this is a fund that's run by Max Altschuster. apologies if I mispronounced your name there, Max. I think I've read it a million times, but I've never said it out loud. But so Max and the GDM fund incubated this. The CEO is Mark Cosgalo, so the former global VP of sales from Outreach. So the idea behind Operator is actually something that we've talked about on the show before. And it's this idea of using AI to be able to surface the accounts and the contacts that you should be pursuing now, right? So not based on just external triggers like someone's raised funding or someone has, a new VP of sales, but by looking at all of the data that you have access to. So your current customers, the previous success you've had in certain segments, the triggers that led to that success. And the idea here is that Operator will surface to you and say, hey, based on the unique position that you sit in within the marketplace, these are the accounts and the contacts and the contact information that you need to go and start sales conversations now, right? So it's about interpreting all of this data and helping sellers to be a lot more targeted on who they should reach out to and when. So I think this is the killer use case for AI in sales, right? The idea around like AI SDRs and AI cold emails and AI cold calling is interesting. I think we're seeing there is some commentary that these platforms aren't working that well. This to me is the area where AI can make a real difference for go-to-market teams now, right? Because what is AI good at? AI is good at synthesizing information and then making recommendations off the back of that information synthesis. It takes humans a long time to be able to synthesize lots of data and then make decisions off the back of that, right? That's something that computers are really good at. And so I want to read you this excerpt, and I'll link to this in the show notes. This is an excerpt from an article on the launch of Operator. Operator does more than just stitch together data sources, though. The platform provides rich insights specific to your business and unique ideal customer profile so that the prospecting efforts are less about optimizing the volume and touches and more about attracting the best possible customers. Operator's heat map visualization of prospect relevance has been a favorite with early customers. Better yet, Operator offers seamless workflows to make these insights actionable for sellers, whether that is automatically purging bad data from the CRM or enabling sellers to send automated triggers based on real-time insights. And perhaps best yet, they've built the solution in a way that democratizes access to these insights. No technical chops required. So this is likely a really big challenge to two companies that are pretty popular in the go-to-market space at the moment, right? Number one is ZoomInfo. So we talked a couple of episodes ago about ZoomInfo's Copilot solution, right? ZoomInfo Copilot is trying to do a similar thing. The interesting thing here will be how much of your existing data does Operator pull from, right? Because the way that we look at, or the way that I understand ZoomInfo's Copilot is it's more about kind of external information. You set up kind of the things that are important to you, and ZoomInfo will monitor the external market in order to help you identify companies that fit that profile. If Operator does what I think it's going to do, it's going to look at the customers that you've won and had success with in the past first, then use that to go and find matches in the market now. If that is the way the product works, that is going to be a large step up from the offer that ZoomInfo has in the market. The other company that could be disrupted as a result of this is Clay. And potentially here in this line, they're taking a shot at Clay, right? And perhaps best yet, they've built the solution in a way that democratizes access to these insights, no technical chops required, right? So Clay is a tool that basically allows you to pull data from a bunch of different sources, create workflows that automate outreach. But the problem with it is that there is some technical knowledge required in order to get it set up, right? There's a bunch of like Clay agencies that have been established to help companies to build these workflows and these automations to run these kind of automated outbound campaigns. If Operator does this out of the box, this is going to potentially be a competitor to Clay, which is kind of operating in this market really like unchecked at the moment. The other interesting thing to consider here is that this product, right, was incubated at the GTM fund. The GDM fund is a venture fund where the LPs, or the investors in the fund, are the go-to-market leaders at the largest SaaS companies in the world. Now, if that isn't an advantage for a go-to-market product, I'm not sure what is, right? The distribution that these guys will have out of the box is pretty impressive. And if the product is designed in a way where usage helps to improve it over time, then this product could potentially be in the hands of tens of thousands of sellers relatively quickly, which is going to make it difficult for competitors to catch up, right? So yeah, look, details on this product are still fairly limited. I'll keep an eye on it over the next couple of weeks, but go and check it out, the Operator There'll be a bunch of information on it on LinkedIn. More details to come, though, I'm sure, over the next few days and weeks. All right, that's it for today. Thanks for joining us. Next week, we'll be taking a look at an early preview of the Sales Science Q2 SaaS Metrics report. I'm about 60% of the way through creating this report. So next week, we'll do a preview. We'll have a look at ARR growth rates. We'll have a look at CAC payback, magic number, and NRR. For a bunch of different companies, we'll have a look at how that metric in Q2 of 2024 compares to the last 2 years. We'll see if we can identify any kind of key changes in those numbers over that time. We'll also look at Q2 earnings results for Rubrik, UiPath, DocuSign, and GitLab. All right, that's it. Thanks for watching. Again, if you have any feedback, please let me know. I want to make this as entertaining for you to watch and listen to as it is for me to make. So any feedback is welcomed. I'll see you next time. Until then, goodbye.